one's called Talking Your Book. It's essentially looking at the equities that investors are picking. It's looking at the trends in the industry and where people should be looking for success over the next 6 to 12 months. I'd like to welcome Mining News editor Kristie Batten to the stage. She'll be moderating the panel. And we've got Sharad Bhat, who is an analyst with Morgans. Nicholas Boyd-Matthews is executive director. Sorry? We don't have Nicholas, apparently. But he is actually Director and Chief Investment Officer at Eden Asset Management still, even though he's not here. David Franklyn is Executive Director and Head of Funds Management at Argonaut. Please welcome your panel.
All right, let's get straight into it. This is meant to be a pretty relaxed discussion, given it's the closing panel. Sharad is an equity analyst, but David is a fund manager. So I was just going to start off by asking you if you could tell us a little bit about the fund and how it's performed over the last year.
Yeah, thanks for that. So we've got two funds. We've got the Argonaut Natural Resources Fund, which has been in operation since January 2020. In the financial year just passed, so the year to June 23, we're up 27%. And our average annual return since inception is 37%. But as I often say, it's all about what you do from here, right? So we'll see how we go this year. We've also got a gold fund, which we kicked off in November, and that's up 17.3% since starting. So so far so good. Yeah.
So so I take it from that one of your favourite commodities is gold.
Yeah, we like gold, but we also like, if there's one theme that's going to drive resources over the next 10, 20 years, it's all about energy transition. Mm-hmm. So the key commodities we invest in are, copper, nickel, lithium, rare earths, looking at graphite, vanadium, those kind of commodities, uranium. We think that's where you want to be, which is a bit different. Resources historically in Australia has been driven by, iron ore and coal and oil and gas. Mm-hmm. And while we think they're okay, we think, the real excitement is in these other commodities, which at the moment from a market cap perspective is still pretty small. With the funds, we invest from the biggest companies to the smallest companies. And really we probably orientate towards producers rather than developers or explorers, but we'll also take a view on the market. So if we think there's risk, we go into bigger caps. And if we think it's more conducive, we'll go down sort of the size chain.
And Sharad, what about you in terms of commodities?
Being a geo, I cover a lot of gold companies, mostly producers, and we've seen a really good, exciting space over the last year, FY23. The gold index has outperformed the broader equity markets by 24%, and that's largely driven by central bank tightening. You see the interest rates are rising. You've seen unemployment rate to historical lows. And I feel like covering a gold analyst, it's a store of value, and it has delivered. And in terms of the value delivery, I think most of the value have come from the mid tiers, the mid caps on the ASX, the cashed up miners. They're very conservative, and they've got no debt. They've got good operational cash flows, and they're sitting on the fence and waiting to acquire assets and projects based on operational synergies. So yeah.
So someone's waiting in the wings to become the next Newcrest when Newcrest gets gobbled up.
Yeah, we've seen it from a large cap to a mid cap. We've seen a flurry of activities, and I think in that sort of regard, the question would be what assets would be divested, and who would be the potential buyers of those assets.
So both of you are mostly focused on producers in what you do. What are the key trends that you are sort of monitoring at the moment in the mining sector? I'll start with you, David.
Yeah, look, I think the question is short term versus long term. When you look at commodities like copper and nickel, you go, hey, they look fantastic over the long term, but they're also very exposed at the moment to global economic growth. Both from the Western economies, but also from China. So what's interesting is I'm a lot more confident, for example, where the copper price might be in 5 years' time, rather than what it might do in the next 12 months. So that's really the issue. The macroeconomic factors that really drive resources are a bit uncertain in the short term, but long term it all looks pretty good.
How about
Yeah,
you?
I 100% agreed with Dave there. Long-term boys, you know, if you have to believe the energy transition, if you have to believe the COP21 targets, you know, as discussed yesterday, you know, FY 2030, you know, OECD countries have put a very aggressive timelines, they've put aggressive targets, and so have global multinational businesses. And post FY 2050 is where, you know, you get net zero, and that's for developed markets, and emerging markets would follow. So taking a long-term view, and mining is a long-term game, like, you know, battery metals, like, you know, lithium, copper, graphite, vanadium, they have a strong demand projection, like, you know, 25 onwards.
What about, I mean, we've probably got a few short-term or shorter, you know, retail investors in the room. What about the shorter-term outlook, even to the end of this year or, you know, end of financial year? It's a bit of crystal ball gazing.
That's one for you.
It's quite, disclaimer is, it's very challenging to predict, you know, the short-term outlook. But, like, you know, considering I do cover gold, and gold has had a good run, I feel that when interest rates sort of, or there's a perception that interest rate flattens, we see some, you know, weakening of US dollar, and I feel that US dollar, gold would go for another run. So quite bullish on gold in a tactical space.
Mm-hmm.
Yeah.
Yeah, I mean, I think gold's been fascinating how it's performed over the last year. I mean, in an environment where interest rates have risen significantly, you would have thought that would be bad for gold, and gold's held up as you're saying, it's been the best performed commodity over the last 12 months. So that's got to give you confidence. A lot of that buying's coming from central banks who are saying we don't want to hold US dollars, we want to hold something else, and gold is still that store of value. So I think that looks good. Over and above that, for other commodities, probably the safest, or the approach we've taken is to say, let's in the short term focus on commodities that are linked to energy transition, but not as linked to the global economic growth in the next 12 months. So things like uranium, you know, rare earths, in particular, make some sense.
Just to add to what Dave said, like, one way to play, I would say, is having gold and copper in the mix.
Mm-hmm.
You know, we see gold, copper, porphyry deposits, because that, it's like one end of the spectrum we have gold as a good hedge, at the other end of the spectrum we have Dr. Copper. So it's sort of an all-weather portfolio. If you look at the large mining companies, if you look at, you know, Newcrest, you know, the reason for acquisition was gold, but also copper. You know, by end of this decade, you know, they would have a higher percentage, about 50% in their portfolio would be copper. You know, someone like, I think there was a report that Barrick was, you know, going for First Quantum. Again, that's a gold miner going for a copper. So it's sort of an all-weather portfolio strategy. In the short space, in the short term, what it does is it drops the cost for the mining company, having a copper credit. And maybe in the future, the gold company would transition to become a copper company.
Well, it's interesting you say that. At Denver Gold Forum, which is happening now, last year, there were lots of commentary around how, you know, perhaps it should be the gold and copper forum. So it'll be interesting to see if that commentary comes out again from this year's event. I imagine it will.
Yeah.
So just moving to some like stocks now. What are your top picks at the moment, David?
So the ones I've sort of thought I'd talk about are at the smaller end. So, and as I was saying, our portfolio is typically 50 to 70% producers and bigger market cap companies, but I'm cognizant of the forum that we're in. So the ones we like at the smaller end, Orteco, which has just secured a copper gold project in Newfoundland in Canada, which is a tier 1 location. What's interesting about it, it's got an established resource. It's also got infrastructure in place, and it's fully permitted. Market cap's still pretty low. An established group of people behind it, Steve Parsons, who was recently involved in Bellevue Gold here. So we think that's interesting. Cygnus Metals, also in Canada, James Bay, relatively early stage exploration leases, but all around a lot of the major or the emerging lithium projects in Canada. Again, market cap sort of just over 50 mil, just raised a bit of money. So we like those. And then on the rare earth side, I think Meteoric, which has an ionic clay project in Brazil, is probably the most exciting rare earth project in the world today. Still relatively early days, still plenty of risk, and the market cap is reflecting the interest. You know, its market cap's over 400 million already, but high grade rare earths, low operating costs if they can get it away. So they're kind of the three at the smaller end. Probably on the uranium, I'll just touch on that. We're also a shareholder in NextGen, which is I guess the highest grade, best quality uranium project in the world today, and going through its permitting process, which we think will get through that. We think the Canadian government is pretty supportive of uranium, but that's pretty exciting too, but much bigger.
And at what point, you know, especially at that smaller end, at what point, like how long do you sort of keep an eye on those companies, and at what point do you decide to invest?
It really depends. It depends on where the market is as well. So when we're worried about the market, we tend to stay out of the small caps. I mean, when there's volatility, you need liquidity. So whereas I just think a lot of those companies have been bashed down a bit. And what you're seeing in the lithium space, for example, is the producers are kind of out of favour because the lithium price has been coming off, but a lot of activity in the explorer space and developer space on the back of corporate activity. So it's a pretty unusual market. So we're always looking for value and quality. You know, what we're looking for, firstly, is you got to be in a decent location. You don't want to be stuck in countries where there's risk. And the project needs to have the ability of scale and competitiveness. So it needs to be low cost, good grade, but it needs to be meaningful. If you're going to go into that level of project, you want to mitigate risk.
And Sharad, what about Morgan's top picks at the moment?
In terms of exploration or project development, I would say, I'd like Saturn, where it sits. Western Australia, safer jurisdiction, got a decent size ore body. It's surrounded by active producers. They're progressing their scoping study, I believe. In terms of copper, just based on the sheer size of the deposit, Caravel looks good. It's got it's again 150 k's northeast of Western Australia. It's got a resource of around 2.8 million tons, reserve of 1.4. You know, good infrastructure, 60 tons per annum. You know, they're doing a DFS. Looks solid. Internationally, you know, copper-wise, it's hot chili. It's South America. Again, 3.5 million ton contained copper. So those would be ways to, you know, play copper and gold. But also there's mineral sands. I sort of like mineral sands because mineral sands business is one of the few commodities that there is price opacity. So what that means is it can lead to inefficiencies, market inefficiencies. I don't see it on my screen daily. I don't see what the price of, I can see what the price of uranium is doing, what the price of gold is doing. But mineral sand, it's a tough market. It's quite challenging in terms of its composition. In terms of its application, it's widespread application. It's used in, you know, flights, golf clubs, pacemakers. It touches all the facets of modern day metal. Modern day, it's not a critical metal, but also if you look from a demand point of view, like if you look at gold company, they would supply 1% of the gold production, but mineral sands are large concentration of producers. In terms of the end user market is not concentrated to one country. There's a big demand from Europe. There's a demand from the US. There's demand from China. So there's a diversification, a customer diversification, and rutile rutile is used for, like, you know, Europeans love it because it's a cleaner product to make titanium metal, whereas, you know, like the lower grade ilmenite goes to China. zircon goes to Italy in terms of the housing market. So yeah, and there are players in Western Australia like Strandline. If one has a higher risk appetite, there's companies like, you know, in Africa, which is at the pointy end, but subject to one's risk appetite. That's a way to do it.
We've got loads of time left, but if we've got any questions from the audience at the moment, anyone? Oh, hang on, we've got a mic coming. Oh, we've got a couple.
Yeah.
What assets do you see being coming up for takeover in the next 12 months?
That's a tough one. I suppose it depends on how hungry the acquirer is. We've seen, as we said, we've seen a lot of activity happening in the mid-cap space with, you know, Musgrave and Ramelius and Westgold. But I view these miners the mid-cap miners are very, very conscious. They're sitting on the fence. They're cashed up. But I think in the large cap space, you know, I would say the tier 2 assets, Newcrest tier 2 assets, somewhere in Mexico, and some in Western Australia maybe. It's subject to asset sale. So yeah, it's a tough to answer.
I guess.
Yeah,
sorry. No, you go.
I think on the gold side, what's interesting is you're seeing some consolidation now, particularly around sort of the Laverton, Leonora kind of area, and I think that'll continue. What existing groups are always trying to do is grow, and often an easier way to do that is to buy other groups that are close by that have a resource that they can sort of build into their infrastructure. So I think you'll continue to see that, particularly in the gold space. And you're seeing, and then for different reasons, you're seeing it in the lithium space. I think, around the MinRes, some of their resources, they're looking at putting their foot on players in the region, again from a consolidation. But then you've also got people like SQM looking for the larger scale opportunities. And Rio, I think, have come out recently and said they're also looking for that. So hence something like Azure. I think if you've got a commodity, a battery material, which is global scale in a tier 1 location, and ideally near someone else that has infrastructure in place, good chance someone's going to have a crack at it.
Yeah. Another thing to add to it, we've seen the cost, it's through the roof. Inflation is high, hard to get skilled labor. And I think, and that's doing, it's cheaper to buy versus cheaper to build. Buying assets like that gives a kick in terms of top line growth as well as bottom line growth, and takes the risk away. Although you pay a premium, but it's better than to, you know, wait a few months and wait a few years and build something and raise money, and you know, so it's preferred option, cheaper to buy than versus build.
I'll come back to Chris, but just to follow on from that, obviously, you know, it's harder for juniors to raise money at the moment, whereas the producers, you know, the mid-tier space still have really healthy balance sheets. Do you think we'll see more of them sort of taking advantage of those depressed valuations in the junior space? Like by just exploration farm-ins, you know, things that they couldn't have gotten their hands on before because the company could just raise cash.
Yeah, I think that's a likely way, as long as, you know, the asset has scale, or the asset has operational synergies, and that can add value to the acquirer. That would be the way to play it.
Chris?
Yeah. Anyone else want to ask a question? I tend to monopolise this. No. I wanted to ask about, excuse me, other kind of poorly understood commodities. Sharad, you mentioned mineral sands, and David, you talked about meteoric in terms of ionic clays in rare earth. I think a lot of investors, it's like easily understood commodities like copper and gold, and there are a lot of these new commodities where people don't really understand the markets. Maybe the markets aren't as transparent.
Yeah.
Are there certain commodities where you guys have done a lot of research and feel like you've unearthed a great opportunity that people haven't quite realised that you could share with the audience?
Yeah, I mean, I think it's a good question, but the way I look at it is you also want to be in commodities that people know and understand, because they're more likely to buy the companies that produce them. When you get more into the more nuanced commodities, and niobium is a good example where, you know, a great discovery in Western Australia recently and the prices all run, but most people have got no idea what it is and what it's used for. The market's very small, dominated on China. So you say, well, it's kind of interesting. You say, do I need to be there? And as a fund manager, where I'm going to have to take a reasonable position, does this make sense, right? So I think you've got to be careful that you're not entering markets that are actually a bit opaque and difficult to understand. I think the really interesting commodity that kind of crosses that is graphite, where you go, well, there's shitloads of graphite in a battery. Well, you know, why isn't the price going? But then you say, well, where is it, right? And it's mainly in Tanzania and Madagascar and Mozambique, and you go, well, they're not my favourite holiday destinations, and the price has, you know, been depressed. So, you know, you've got to be careful about going into those commodities which are a bit more difficult, because in energy transition, you don't need to go there, right? So, and I think with investing, you've got to be really disciplined in what you're in, and making sure that once you get in, you can get out. And in some of those commodities, there's also the risk of price manipulation in those more opaque markets, and particularly when they're dominated by China, where you know, graphite prices are currently, and niobium is, and rare earths are. So, you know, you just got to be careful and selective in the assets you go into.
Anything to add?
Yeah, like, I think for investors, you've got to be clear. You've got to have a clear view, or you've got to take a view on the outlook. I think that's a starting position. And you know, it's safer to play in a commodity that is sort of is there for a decade and centuries, and there's data behind it, there's clear supply dynamics behind it. So that would be the way to play it. But I would sort of still look into opportunities that you know, future holds, like, you know, having a sort of a value hat on. You know, although, you know, it is opaque, maybe it's opaque, but that in the future, that if I can hold it, you know, that can provide a better upside. Or it's kind of depressed because market doesn't understand this sort of genre of commodities, and I'm keen to get in. And although it's, yes, 100%, it's riskier, it would be less liquid. Yeah. But yeah, it's you know, it's pick your adventure.
And how about ESG? How, you know, as an investor, how much time and consideration do you sort of, you know, give ESG?
Yeah, well, it's critical. I mean, at a couple of levels. One is, you know, the commodities that I think will perform best are the ones that are really fueling, you know, the energy transition and the move away from fossil fuels. So, you know, copper, nickel, lithium, rare earths, etc. What we also try and do is focus, where possible, you want to be investing in a tier 1 location, and that's one, because there's less investment risk, but two, those locations in countries like Australia or Canada are really leading the world in ESG, about the way they go about mining, the way they look after their staff, and the way they look after the environment. So we kind of focus it that way, but it's critical. I mean, if you're producing a commodity in a non-ethical way, you're not looking after your staff and the communities you operate in, and you're damaging the environment, you don't have a long-term future. And as we move forward, there'll be a lot of tracking of the commodity from the resource in the ground to the end market. And if you're not meeting those ESG requirements, then you won't be able to sell your product. So.
Working in past life, working for global mining companies like BHP and Rio, it was very stringent to look at any project through ESG lens, and that not just the start of the project. Of course, location plays an important role. It is paramount where the assets are. But in addition to that, like, you know, engagement with traditional owners, what happens when, you know, how do we extract water rights, you know, what the closure commitment looks like, what the closure cost looks like, how the landscape evolves post. This is 30 years from mining. So it's an important aspect of investing in an asset or in a business, not just looking just at the start, but entire value chain in terms of the footprint, the carbon emissions, the closures, and what's going to happen to the impact on the environment post closure. So it's a very holistic sort of a lens that organizations these days put, and also like investors are keen to make sure the investments are in an ethical fashion. It provides bang for buck. At the same time, it ticks all the other boxes.
And how do you model that in a research model?
ESG is it's not a financial metric. It is more subjective, so to speak. It doesn't have an ROI or ROE for that matter. It depends on company's intention. It depends on company's core value. It depends on doing the right thing for the asset as well as for the community. So it's a tough one. It's like you can't measure, and we measure we measure based on water intensity, carbon emissions. There's some frameworks around it. ICMM is one of the global entity has provided some framework, like a high-level framework, but it is not a financial metric, so it gets a bit tricky. But there are key parameters like water use, carbon emissions, things like that.
Do we have any more questions from the audience? Yep, there we go. Mike.
I'd just like to follow up on that subject. Obviously, all producing miners in Australia have to report federally on their emissions and at various levels. But what I don't find in their ESG governance statements is what the impact would be of a future carbon price if it was implemented based on whatever the trend line is for their own emissions. And I'm wondering how much you might speculate on that in your investment decisions.
So in terms of carbon pricing has been a very touchy topic. And look, it's, to be honest, I don't know what should be the optimal or ideal price for carbon should be, because that would be a game changer. It'll be a make or break for projects if you start implementing a price. Most of the assumptions, factors, trading carbon credits to offset your emissions. And the net zero scenario is based on a carbon credit system where businesses are happy to take an arbitrary carbon price. And that can be subjective from A to B or B to C company.
Yeah, what we're seeing, and you're seeing as well, a lot of companies now, when they're evaluating projects, are building in a carbon price. So I think the industry's aware that the world's going to change. What we do, and I'm sure Sharad takes a similar view, and that is when you're looking at projects, it just reinforces they've got to be high quality and low cost because costs are likely to increase. Ideally, commodity prices will increase as well, and kind of the margin can be maintained. But I think it's a factor that will become more and more prevalent and relevant. Yeah.
We might finish off by, I'll ask you, what is the single biggest risk and opportunity for the mining sector in the short term? We'll go with risk first.
The biggest risk, I think the resource market is still very dependent on China, and I think the Chinese economy over the next 12 months and how it recovers from its slowdown will be critical. So in the short to medium term, I think it's all about China. Without an upturn then it's hard to see commodity prices really rallying away, particularly where you've got Western economies probably reasonably sluggish.
Sharad?
Yeah, I reckon China is elephant in the room here. There are a lot of concerns around housing and housing crisis coming, like cracks in Chinese market, but also the US in terms of we've seen the Feds are raising rates aggressively, and when is it going to stop? It's going to stop sometime, but there's rumors that another couple of rate rises is going to come through, and what that does, it causes volatility, that causes fear in the market, and I think that would be something to look out for. Can the Feds control the inflation? If not, then expect rate rises to.
On the flip, on the flip side, biggest opportunity?
Look, I think it's still, as a big theme, it's still energy transition. And I'll give you an example of that because, I mean, you've probably seen presentations today talking about the demand for all these commodities, whether it's copper, nickel, vanadium, lithium, uranium, you know, they're all going through the roof. But when you look at what brokers in their reports are forecasting commodity prices over the next 5 years, a lot of them are flat. You know, take copper, for example. Copper's currently trading about $8,500 a tonne. You know, on the consensus numbers, 5 years out, you know, it's about 9,000. So you're saying copper demand's going like that, prices going like that, doesn't make any sense. So, so it really makes you question the valuations that are being applied to copper producers in particular, but developers, in that something needs to happen. Either energy transition is not going to happen, or else prices are going to be much higher than what most people are projecting in their valuation models.
Biggest opportunity?
I think the way I see this is I feel that there's a fundamental structural deficit in battery storage space. So I see massive opportunities in development companies, in explorers, because you know all they have to do is just wait, polish the assumptions, de-risk the project, work on flow sheets, work on financing. And when the market improves, it's you've done the homework. That's the time to pull the trigger. So I think that's where the opportunities is within the battery space, within the developer space, particularly with assets, with companies with good large asset bases, good scale, quality grades, access to infrastructure, and those companies are waiting in the shadows. And upsides on the horizon.
Well, unless we've got any more questions, I feel like that's a nice positive note to finish our panel on, and the conference, I guess.
Yeah.
Thank you.
Thank you.
Thank our panellists, please.
Cheers.